Can anybody hear me? Good morning.
Good morning. Yes, we can hear you.
Oh, thank God, huh? I'm pretty good fixing these things, huh? The only thing I know how to do is reboot, but it seems to work. So you can hear me, Kennedy? And John? John is mute. Okay. All right, let's wait one moment. We'll go right into the chapter. It's kind of a long one. It brings up the real fundamentals that we need to master before we get into accounting 230 plus, we'll say, okay? Anybody not hearing me, gesture, chat, just let me know, okay? I'm assuming you guys are all hearing me now. So I'm going to share a screen. Whoops, that didn't work, did it? Share the screen. Come on now. Share. Having a tough day technically all of a sudden. Okay, hang in there. I had this all racked up, and then when I reboot it screws me up. Okay, we gotta go here. Gotta go here. Get into that. Okay. Hang in there with me. We're off to a tough start. Okay. Can somebody please verbally let me know that you can see the PowerPoints, please?
I can see them.
All right, thank you.
Thank you.
After a 10-minute delay. I'm so sorry, guys, for all the technical stuff. Okay, here we go. Chapter 3, we're going to get back and we're going to talk about that crusty old accounting equation. Assets equal liabilities plus equity. We're going to run through some transactions, just showing you how the accounting equation is impacted. And once we've done a dozen or so of those transactions, we're going to introduce the world of debits and credits. And that's where the real fun begins in terms of learning the accounting, okay? So let's see what we have here. They always talk about these learning objectives, analyze the impact of the business transactions. We're going to be doing that. Debits and credits, you're going to find out about the use of a journal and the general ledger, and eventually preparing a trial balance. Analyze the effect of business transactions on the basic accounting equation. You notice they spell analyze with an S. I believe this is a British publisher. Analyze the effects of business transactions using the accounting equation, huh? What are we going to do? We're going to collect transaction data, and we're going to process that data and communicate it to the decision makers of the company. Collecting transaction data can consist of calculating, bringing together all of the time cards to record your payroll. It can be inventory counts that you took. It could be purchase orders, communications with other companies. It could be something as simple as the electric bill arrived today. We look at the electric bill, it's $100. It was about 98 last month. It was 101 the month before. We can assure ourselves that data is correct, that $100. We process it with what's going to be called a journal entry, and the communication comes out in the form of the financial statements in various subsidiary reports. Here is our journey in the next 2 chapters. We're going through the accounting information cycle. We are going to analyze business transactions in just a few minutes. You're going to learn how to journalize them and post them. Journalizing is the recording of the transaction into your system. The posting is when you take those journal entries and put them into the general ledger. Posting, there's no turning back. Once we've got everything done for the month, we're going to run what's called a trial balance. We're going to adjust that trial balance because the trial balance by definition is not going to be correct. We get an adjusted trial balance. From that, we do the financial statements, the closing, and the post-closing. So as the chapter goes on, we can follow the blue arrow and see how far we go. Economic transactions. Any event that require recording. Not all activities require transactions. The company announces that they just hired a new executive officer and they're going to pay this woman $1 million a year. Well, that's not an accounting transaction. They're just making an announcement that they hired somebody. But they like to put something like that on the test. Make sure that you're reading the question correctly. There's no economic activity. There's no transaction until the lady goes to work and starts collecting a paycheck. Not all activities require transactions. Assets, liabilities, and stockholders' equity, they have to change as a result of the economic event. At least one of them has to change. And they have a dual effect on the accounting equation. You must have two. We're going to talk now in terms of pluses and minuses. You have to have a plus and a minus, or 2 pluses, depending on where you're working with the accounting equation. Are the following events recorded in the accounting records? You purchased a computer. You purchased a computer. Of course you record that. There's your invoice. You paid the rent on the far right. Of course you did. Discuss guided trip options with potential customers. No, that's not a transaction that cost you any money or did anything to impact the company. So that's an external event, we'll call it, not requiring any accounting processing. None at all. The process of identifying the specific accounts, economic events on the accounting equation. Look at our equation. Assets equal liabilities plus equity. You have a business with $1 million and you offered to sell it to me for $500,000. I would be nuts to do that without knowing how much you had in liabilities. Maybe you had $1 million in liabilities and the company was valued at 0. So assets equal liabilities plus equity. Assets, anything of value owned by the company that's going to contribute to the profit-making process. Liability is a debt. It's an IOU. It's a chit. That's money we owe to people. And stockholders' equity is the book value of the company, what the company is worth on paper. And keep in mind, interestingly, what the company is worth on paper may have nothing at all to do with what it's really worth in terms of the marketplace. And we're going to go over that fairly soon. Accounting equation must always balance. I don't think any of you who go out and work in any kind of accounting world at all is ever going to go out of balance. No computer system is going to let you do it. Back in the old days when stuff was done in pencil on big, long pieces of paper, yeah, you could make a human error and go out of balance, and it was an unbelievable disaster to fix. Each account has a dual effect. There must be a corresponding increase or decrease in the assets, liabilities, or stockholders' equity. Let's take a peek at this now. Here is your accounting equation presented once again. Assets equal liabilities plus stockholders' equity. Look at the components, if you will, please, of stockholders' equity. It consists of common stock. In this case, the company raised money by issuing stock to the public. So the public owns a certain percentage of this company's stock. The company made some money over the years. Those monies are going to be accumulated in a stockholders' equity account called retained earnings. Revenue, whenever you have a revenue or a sale, it increases stockholders' equity, just like all expenses decrease stockholders' equity. So when you take the revenues minus the expenses, that's the net income. And that's the net income that's going to roll up into the stockholders' equity at month end. And then the company might be in a position to give out dividends, which people love. I live on my dividends as an old guy here from a couple of companies. Dividends, that's part of stockholders' equity, and dividends would reduce your stockholders' equity. So let's go through some transactions. If I tend to go pretty quickly here with my New Jersey fast talk. Anybody wants to slow me down or have a question, please let me know. Let's see what we have here. It looks like we have 11 transactions to work on. Oh my goodness. On October 1st, cash is invested in Sierra Corporation by investors in exchange for common stock. So the Sierra Corporation issued stock to the public to raise money to start their business. So let's think in terms of how is this going to affect our accounting equation? Well, cash is certainly going to go up, right? Cash is going to go up. We had zero, now we have $10,000. So I would expect to see a $10,000 increase here. And what else went up? Common stock, which is a component of stockholders' equity. So there we go. Say hello to your first transaction. Cash went up, common stock went up. Event number 2, they borrowed money and they signed a 3-month, 12%, $5,000 note. Okay, on October 1st, they borrowed $5,000 from a bank and they signed the note payable, meaning that in 3 months, in this case, at the end of the year, they're going to pay back the $5,000, probably plus the interest at that time, or the interest could be paid back monthly, depending. So let's see here. Our cash is going to go up by $5,000, right? And notes payable will also go up by $5,000. So let's see if I'm right. There we go. And we're in balance. We're still in balance. They purchased equipment by paying $5,000 in cash. Cash is an asset, huh? Your most liquid asset. It is liquid. Equipment is an asset. So all we're doing here is exchanging one asset for another. So let's see. The only thing that should change, I would expect to see equipment go up and cash go down. You see that, everybody? Equipment went up because we brought in a new machine or something, and we paid cash for it. We didn't, not through accounts payable. Number four. Sierra received cash in advance from Arnox, a client. Cash goes up, but you notice that the 1,200 comes under an account called unearned service revenue. We're going to get into that later on. Just real quick, unearned revenue represents cash that you received in advance of doing anything for the customer. A good example would be a lawyer. You want to have the lawyer work on your will, say. You go to the lawyer's office and the lawyer says, I'll be glad to do it. You just have to give me $1,000 retainer right now. So you give that lawyer the $1,000. Well, when he gets that money, he's going to increase his cash, but he cannot call that revenue. He cannot call it revenue. It's called unearned revenue, which is a liability. You owe not money, you owe service. On October 3rd, Sierra received $10,000 in cash for services performed. Okay, Sierra is probably, it looks like it might be a tourist type place. Maybe they take people around the Grand Canyon or something. So they got cash. What do you think the other half of that is going to be? Cash revenues. There we go. We have our first income statement account. Cash went up and so did the revenues. So at this point, this company has a profit of $10,000 because they've not incurred any expenses yet until event number 6, when the office rent came due and they paid it. Paid the office rent. Whenever you see the word paid, you know it's cash. Cash goes down 900 and expenses go up 900. The reason they're showing a minus sign in front of the expenses is just to remind us that it gets subtracted from the revenue. But believe me, the expenses went up. Here they bought an insurance policy. They paid $600 for a prepaid, that doesn't say prepaid, but for a 1-year insurance policy that expires on September 30th. When you buy an insurance policy, by definition, you are buying an asset because you don't get the benefit of that insurance policy until the policy kicks into place. All right. And we're going to do an awful lot of that in the next chapter or two on prepaid expenses. So let's see what we have here. We bought the insurance policy. We bought the policy for $600. We now have an asset called prepaid insurance. And that insurance policy expires next year. What that means, everybody, is that during the next year, we're going to take that $600 you see here, we're going to divide it by 12 and get $50 a month. And every month, we're going to increase our insurance expense by $50 and credit cash by the same amount, okay? Same thing with supplies. When you buy supplies, we want to get you into the habit of calling it an asset, okay? In the real world, a lot of companies just expense supplies, but apparently they're saying they're significant enough here where we want to keep track of them, but not so significant we want to put them in the inventory and trail them that way. So Sierra went out and they bought 3 months of supplies, okay? It could be blankets or something. It could be oars or different things they need to show people around our great national parks. So they got 3 months of supplies on account. On account, you're seeing those two words for the first time. On account means nobody had money in the transaction. So as soon as you see on account, you know there is no cash involved. On account means on account of nobody had money, okay? Once you know it's on account, the next thing to try to understand is whether it's accounts receivable or accounts payable. Hold on, please. Hold on. The attack of the leaf blower. Let's see what we got now. Sierra purchased those supplies, 3 months, $2,500. There it is. Supplies go up $2,500. Now, when do we get to supplies expense? When they use the supplies. At the end of the month, maybe somebody goes out and looks in the storeroom and sees that there's only $500 worth of supplies there. That way, you know you used $2,000. Paid a dividend. Woo-wee. Paid a dividend. Paid a dividend. Cash is going to go down. And so is equity. Dividends are not an expense. Dividends are a reduction in your stockholders' equity because, in essence, you're selling part of the company to somebody. So your dividends go up, but because they reduce equity, they're showing it here as a minus, okay? So if you're looking at your equity now, you've got 10,000 in common stock plus 10 here. That's 20,000. Minus this 14, you're down to 18,600. And notice that the equation has been kept in balance. Here we go. Employees have worked the last 2 weeks, earning $4,000 in salaries, which were paid. So what's going to go up and down? Cash is going to go down, huh? We paid cash. And salaries expense is going to go up. You're going to see an expense. No, they don't want to show that last one for some reason, but take it from me. Your cash is going to go down 4,000, and you're going to see another expense here for 4,000. Okay, so that was the poor man's look at how the accounting equation is impacted. We're using terms like up and down, plus or minus. Now we're going to get into the language of accounting. And in accounting, we don't say plus, minus, up, down necessarily. We say debit or credit. And there's a certain number of rules regarding the use of those words that we need to master. Here they're just showing us the detail after, I guess, four transactions with this particular company. What did this company do? They started off, they issued stock, they bought equipment, and they incurred revenue. They got revenue, and then they had a little bit of expense here. So if this was the end of the month, this company's stockholders' equity would be 25,000 plus 8,000 minus that 850. So the 25,000 is going to be the same unless they issue more stock. The profit of 8,000 minus 850, which is 7,250, I believe, that is going to be sitting up in the account called retained earnings. Okay, retained earnings. Explain how the account's debits and credits are used to record business transactions. Every entry, every transaction in business requires one debit, one credit at least. You can have one debit and 100 credits. You can have one credit and 1,000 debits, or you can have a mixture of both of them, okay? Debit and credit procedure, double entry system. Each transaction must affect two or more accounts, obviously to keep the bank accounting equation, basic accounting equation in balance. Recording must include one debit and one credit, and debits equal credits. Now let's see what we're talking about. Debit. Debit means left. Left. Can we remember that? Debit means left. Credit means right. That's all it means. There's no value judgment. One is not better than the other. One is not worse than the other. It just tells the world debits are on the left, credits on the right. Okay? And God forgive me for telling this bad joke that I tell every semester about a gentleman who worked in accounting for 50 years, and he came to work every day. He opened up a small drawer in his desk, pulled out a paper about this big, looked it over, nodded his head, put it back. When he retired, they wanted to know what was on that piece of paper. So they opened up his desk. You know what it said? Debits on the left, credits on the right. I'll let the laughter stop now. Believe me, you're not going to take 50 years to figure this out, okay? What you're being shown here is a T account, which mimics your general ledger. So we can think of this as your general ledger, books of original entry. So transaction one, we had $10,000. Do you want to see something? Okay, they're not giving us a transaction. In this transaction here, whatever we did, we increased, we'll call it cash just for the heck of it. We increased cash by 10,000 with a debit, and we increased cash with an 8,000 here with the debit, and we credit. But the purpose of this slide is to show you how to get the balance. You add all the activity down on the debit side, and you subtract the activity on the credit side, and you're going to come up with a balance of, in this case, 15,000 debit. It could have been 15,000 credit, depending on what the account is. So debits and credits left and right, just to get us started. If credits are greater than debit, you end up with a credit balance. So this shouldn't be too hard. We have a debit of 10 and credits of 11. So we now have a credit balance in whatever account that is. procedures for assets and liabilities. Asset accounts, I'm going to say this clearly as I can. Asset accounts, assets should have a debit balance, okay? Assets have what is called a normal debit balance. A normal balance is the side of the T account which increases the number. Assets have a normal debit balance. And there's no other way I can teach that other than to have you do some problems, do your homework until it kind of sinks in automatically, okay? You're sort of learning a new language and there'll be stumbles on these. These can be pretty tricky for a while, but I know you'll knock them off. So assets have a normal debit balance, but look at liabilities. Look at this. Liabilities have a normal credit balance. Credit balance. So assets have a normal debit balance, liabilities normal credit. And again, the normal balance is the side where increases in the account are recorded. Let's look at the rest of our rules. And this is everything. It's just 6 things to pick up, but it can be a little tricky. We just learned that assets go up with a debit and liabilities go up with a credit. Assets equals liabilities plus equity. Therefore, equity would have to also go up with a credit. Equity goes up with a credit. So assets equal liabilities plus equity. Assets go up with a debit. Therefore, liabilities and equity must go up with a credit. Now let's look at the components of stockholders' equity. What's in stockholders' equity? We decided that common stock is there, and that common stock or equity has a credit balance. Retained earnings, we hope it has a credit balance. It could have a negative balance if the company's been losing money, but we normally say retained earnings has a credit balance. Dividends have a debit balance, all right? Assets equals liabilities plus equity. Assets debit balance. Liabilities equity have a credit balance. Just 2 more things. I forgot there were 2 more things to look at. Come on. The 2 things we want to talk about now, revenues and expenses, sales and expenses. Revenues increase stockholders' equity, as we know. Expenses do the opposite. The effect on revenue and expense account is the same as what it does to stockholders' equity. But let's look at it more simply. Revenues have a credit balance. Expenses have a normal debit balance. Revenues are increased with a credit. Debits are increased. I'm sorry, expenses are increased with a debit. All right. Hey, the Chicago Cubs. I'm a big baseball fan. The Cubs have these major revenue streams: players' salaries, admin salaries, travel. I'm not quite sure where they show that grid. Just comes out of nowhere. Let's go back to the financial statements, which you learned a little bit about, huh? We have assets, liabilities, and equity. That's the balance sheet. Excuse me. The balance sheet, assets equal liabilities plus equity. And what they're showing you here is what impacts stockholders' equity. Well, common stock is the investment by the stockholders when we issued cash. Retained earnings goes up by net income. Here, net income. Here it comes down into the retained earnings statement. And if we had any dividends, they would reduce retained earnings. Common stock, we issue stock to the public pays us. Retained earnings, I'm going to talk about a little more. Retained earnings is simply a part of equity. It also has a credit balance. Retained earnings represents the cumulative earnings of the business from the first day. You began this business here for $10,000. At the end of the first month, you made a profit of 1,000. Well, 1,000 is going to be shown as an increase to retained earnings. The next month you made 4,000, it goes up to 5, etc. What will reduce it though are dividends, okay? So retained earnings is where we pass through the income and dividends. Okay, here's a grid where they're showing pretty much everything together. These are the 5 guys that you have to understand. Assets, debit, expenses, debit, dividends, debit, and then liabilities and revenues, credit. Those are your 5 food blocks there, okay? I mean, I can give you some mnemonics if you like. After eating dinner, let's read comics. After eating dinner, those are your debits, assets, expenses, dividends. And then on the other side, let's read comics, liabilities, revenue, and capital, okay, or equity. Here's another visual. It's up to you which grid helps you the most. I think I'm sort of a nerdy guy. I do it best by reading, but some people, do better visually. Here they're just showing you that assets and expenses are your debit increases. The rest are credits, huh? And they're giving you another grid that might be helpful to you with this expanded look. Assets equal liabilities plus equity. And equity has these 4 or 5 things under its umbrella: common stock, retained earnings, revenues and expenses, also called net income, and the dividends. And it must be in balance, huh? Summary of debit and credit rules. Summary of debit and credit rules. Debits increase assets and decrease liabilities. Okay? This is the kind of thing you have to have in your skull automatically. This is the exact type of questions you'll get on the test. They'll say debits do what, and then they'll give you a few scenarios like this. So understand the debits and credits. And you can tell how much I emphasize that, because once you're comfortable understanding the debit and credit, it makes the more complicated things we're going to get into much, much easier. You don't waste time on, is it a debit or credit? You just know it. Accounts that normally have a debit balance, what do you think, huh? I think assets is certainly one. I see expenses, that's good, but not revenues, not equity, not liabilities. The answer better be D, huh? How a journal is used. Okay, remember our journey with the arrows? We've gone through the first of the arrows. We analyzed business transactions. Now we're going to go through the recording process. And this is done through what your book calls general journals or journal entries, which is what the real word calls them. Steps to record. Analyze each transaction in terms of its effect on the accounts. That's kind of what we did before with those transactions. Enter the transaction information in a journal. That's going to be your journal entry. And transfer the journal information to the appropriate general ledger accounts, okay? So let's see what we have here. I see a bill from equipment sales company, okay? This bill came in the mail, and you work in accounting, maybe you work in accounts payable, and the bill came in the mail and they brought it over to the accounts payable person, and he or she opened up the envelope and said, oh yeah, I've been waiting for this bill. You go into your desk drawer, you go into your computer, and maybe you print out the purchase order, maybe the purchase requisition, maybe the receiving report. You staple them all together, and using that little packet, you prepare your what's called the journal entry, okay? Now you're seeing this for the first time. You're seeing a journal entry, general journal. On October 2nd, we recorded this transaction as follows. We debited equipment and we credited sales. We debited equipment, we credited sales. Notice the indentation on cash. All credit line items need to be indented a little bit, an inch or so, okay? That's what auditors expect to see. That's the norm in the world of auditing and reviewing financial reports. So let's see what happened here. We debit cash, so we increase cash. Oh, I'm sorry, I'm saying it backwards, am I not? Ah, my bad. We are debiting equipment. We are debiting equipment and crediting cash, okay? And it looks like the deal was we make a down payment of 5,000. So we brought the equipment in for 5,000, and then we had 5,000 in cash going there. And frankly, this transaction doesn't look right to me. All we did was buy equipment. Where's the equipment going up? I think we have what's called a clunker here, ladies and gentlemen, and I'm going to report that to the authorities. Either I'm an idiot or that doesn't work correctly. No, this is a bad slide. Okay, let's continue. Let's avoid that distraction. The general journal. Transactions are recorded chronologically in the journal before they're transferred to the accounts. Transfer the accounts means posting to the general ledger, okay? Posting is the act of permanently etching the general ledger with the transaction. Once you post something to the general ledger, which you can call the books, if you will, of the company, once you put something in the general ledger, you can't erase it, you can't remove it. You can only put in a correcting transaction to get you where you want it to be in the first place. So the journal contributes to the recording process. It discloses the complete effect of a transaction. There's your chronological listing, helps to prevent or locate errors. So here we go, the process of entering transaction data. Okay, now they brought us back to that same transaction, and hopefully we did this correctly. Sierra issued common stock in exchange for $10,000 in cash, huh? Then they borrowed 5,000 by signing a note. So now they have a note payable going, and they purchased equipment for 5,000. So let's analyze them before we go to the next slide. Sierra issued common stock in exchange for 10,000 cash. So cash is going to be debited and common stock is going to be credited. Those are the normal balances of those categories. Then in the next transaction, they borrowed 5,000 and signed a note. So cash goes up with a debit and note payable goes up with a credit. And here they purchased equipment for 5,000. I assume that's cash. So equipment goes up 5 and cash goes down 5. So here we go. Here's our first journal entry. I'd like you to look at the general journal, the construction of it, okay? When you go into your accounting systems, and whether you're in QuickBooks or Oracle or Mass 90 or whatever, no matter how big or small your accounting system is, you will have your journal entry screen looking pretty much like this. And you're going to go in there and you're going to enter the date. You're going to enter your debits and credits. Try to put the debits in first. Debits should be listed first as a general rule. So if you have a 2-line entry, you certainly want the debit to be the first one. So you debit cash for 10,000, you credit common stock. Your asset cash just went up 10,000, and so did stockholders' equity. You now have a business worth on paper $10,000. Remember, they borrowed money by signing a note? Well, cash is going to go up again. We just brought in another $5,000 worth of cash. Cash comes up. Unfortunately, we're going to have to pay it back someday. And that is in the account we're going to call notes payable. You notice it's not called accounts payable. The reason for that is accounts payable represent the monies you owe to your normal vendors, the people you normally do business with, your suppliers, your insurance companies, your utility companies, people like that. That's accounts payable, the normal business. Notes payable is a borrowing situation. You borrowed money from a bank or something, okay? They're kept totally different. And then he purchased equipment for $5,000. Took that borrowed money and he bought some equipment. So take a look at our general journal again. It's got a date. The top of the page, you could put the year, but you only put the year on top of the page. You put the debits first, debit equipment, and you put it over here, debit 5,000, credit 5,000. Now you have filled out the journal, but you haven't posted anything yet, okay? Okay, so here's what you're going to be looking at. You're gonna come to work one day and you say, today I'm going to catch up on some of these transactions. And you're going to go into your system and do what we just did here. You're going to set these 3 transactions up, but you haven't posted them yet, okay? At this point, they're just sitting there in a queue awaiting instruction. When you finally decide that these transactions are correct and you hit the button called post, as soon as you hit that button called post, all of this information flows right into your general ledger in perpetuity. You can never remove it. You can only correct it with offsetting or correcting entries. Journal entries. Here we go. Let's do some journal entries together. The following events occurred during the first month of business. Here it is, Inc. Yeah, real funny. Here it is. Here it ain't. Kate Brown's Beauty Salon issued common stock in exchange for cash. Purchased equipment on account. We now know that on account means nobody had money. So it's going to be accounts receivable or accounts payable. And since we're buying it, we know it's going to be accounts payable. And then they interviewed 3 people for the position of stylist. How do we record these transactions? First one, issued stock. We debit cash and we credit common stock. We bought equipment, 4,800. Debit equipment, credit, accounts payable. And they interviewed 3 people for the position of stylist. There's nothing there. There's no meat there. It's just no entry. It's good to know. Explain how a ledger and posting help in the recording process. Well, we kind of just learned how to put the journal entries together. And now look, we're up to the 3rd of these 1, 2, 3, 4, 5, 9 arrows, okay? Post to the general ledger. The general ledger, that represents the quote, the books of the company. You ever hear someone say the books are cooked, these numbers are wrong, there's something wrong, there's cheating going on. The general ledger is the master set of folders, if you will, that collect the financial information and yield the balances, okay? So think of the general ledger as a bunch of folders. A company begins and they decide what type of activity they want to cover in their general ledger. Well, under assets, you certainly want to have a folder for cash. You want to have one for accounts receivable, supplies, land, and equipment here. Liabilities account, this company here, they look like they've got accounts payable, notes payable, interest payable, and sometimes they have to accrue wages payable. Stockholders' equity. Well, let's see here. We got some expenses, we got revenues, we got dividends, common stock. So your ledger consists of what I'm going to ask you to think of as folders, okay? And we're showing you the chart of accounts here. And the items in red are kind of the ones we're using in this chapter. That's very helpful. Did we learn anything new in this chapter so far? Yeah, we learned about dividends and retained earnings, common stock, and the unearned revenue. Unearned revenue. Now here we go, the posting process. Here we wrote a journal entry and we debited cash and we credited common stock. You come back later, or maybe a supervisor does this. Typically, it's the same person who wrote the journal entry. You come back an hour later and you decide that you've got all your journal entries done. Now we're ready to post. You look at this one. let's see, we issued cash. Yeah, that looks right. We raised cash, 10,000 comments. This is absolutely right. You hit the post button and look what happens. Wham. The $10,000 debit finds its way over to the cash folder as a debit for 10,000. The balance in cash is now $10,000. The balance in common stock is now $10,000. Post the amount of debit to the debit side and you post the credit side, okay? The general ledger is where the audits typically begin. The auditors are going to come into your business and they're going to look at your cash, of course. And the first thing they're going to say, show me your general ledger. How much cash do you have? And you'll show them this $10,000. Well, that's not good enough. They'll say, okay, show me the details of that 10,000. And then they're going to find the individual transactions. And then they're going to drill down into these numbers. They're then going to drill down into calling the bank, having you contact the bank and verify some numbers. But it starts with the posting. Posting does not occur before journalizing. And I think it's D. I think it's D. Posting transfers journal entries to the general ledger, to your folders. Steps in the recording process. Ooh. Determine what type of account is involved. Determine what items increased or decreased and what the numbers are. And translate the increases and decreases into the appropriate debits and credits, huh? Determine what type of account is involved, what goes up and down, debit, credit. Okay, we're gonna go through these pages kind of quickly now. What they're gonna show us is the transactions I think we did earlier in debit and credit form, okay? So here we go. Stockholders invest 10,000 in a new company. Well, here's what we did before. We said that cash goes up 10,000, common stock goes up. But now we have to be smarter. Now we have to work with the debits and credits. And we say cash is debited for 10,000, common stock is credited for 10,000. Okay, at that point, nothing has happened. All we've done is set up a tentative folder. We hit the word post, we hit the post button, and bam, the 10,000 debit to cash comes over here, and the 10,000 credit to common stock comes over there. Okay. Here, Sierra borrowed 5,000. They borrowed 5,000. They signed a 3-month note. So what happened here? We debit cash. We credit notes payable. Payable goes up with the credit. Now look at our general ledger now. Now we got $15,000 in cash sitting there. Okay. They used 5,000 cash to buy equipment. Okay. We debit equipment, which went up, and we credit cash, which went down. So equipment went up. That's an asset with the debit. And we yielded another asset. We traded another asset for that, $5,000. Just a swap of assets. Just a swap of assets. Holy cow, what do we have here? Sierra received a $1,200 cash advance for future consideration, okay? In other words, this is the classic unearned revenue. So what do we have here? When we were just doing pluses and minuses, we say, well, cash goes up, but so does this liability account called unearned revenue. Unearned revenue. So here we go. We're going to debit cash and credit unearned revenue, 1,200. That money cannot be, we cannot call that income because we haven't done the service that needs to be rendered to recognize it. Okay. Let me give you another example on unearned revenue. You know, I'm a big sports fan. I send in my season ticket money to the Dodgers. I send them a check for $25,000, right? The Dodgers get my money in February. Well, nobody's playing baseball in February. So when they get my money, they debit cash and they credit unearned revenue. The season is 6 months long. So at the end of April, the first month, they recognize 1/6 of that 25,000 as income and then debit the liability account. Here we go. Here, now we got some legitimate income. We managed a tour for some people. We debit cash and we credit revenue. And notice that the cash numbers are getting bigger and bigger. Paid office rent, we paid it in cash. Debit rent expense for 900 and I'm sorry, yeah, debit rent expense for 9, credit cash, right? Sierra paid $600 for a policy that's expiring in the future. When you buy an insurance policy, by definition, I'll say it again, you're purchasing an asset. Because the day you buy the policy, you're not covered. It's only when the policy goes into effect. Typically, you buy an insurance policy in December to cover you for the following year. So until you start getting the insurance coverage, it's an asset called prepaid insurance. Bought 3 months of supplies. We're going to call that an asset, a current asset. Debit supplies, credit accounts payable, huh? Event 9. Sierra hired 4 employees to begin work. They're going to get a weekly salary of $500 for 5-day work week, payable every 2 weeks. First payment made on such and such. There's no accounting transaction there. The company might make an announcement. We are proud to announce the hiring of Joe Bombats. But that's all it is, just information. They paid a dividend. Wow. You will debit dividends for 500 and credit cash. Dividends automatically reduce your stockholders' equity. Dividends are not an expense, not an expense. It's a reduction of your equity because, again, you're giving away some of the company equity. Okay, we got to pay our employees $4,000. We debit cash. I'm sorry, we credit cash and debit the appropriate expense, salaries and wages expense. And now here we go. We're looking at the summary here. These are all the journal entries we just looked at. Now they're sitting there in your queue. There they are again. Okay, they look good to me, huh? They look good to you? If they look good to you, they're good to me. All right. Whammo, we just hit the post button. Say hello to what the general ledger eventually looks like. Each folder, cash, we had a beginning balance of 10, and then we had 3 cash infusions, if you will. We had to spend cash 5 times, and that leaves us with a balance of 15,200. Do we understand how to get the balance in a T account? It's simply a matter of adding the debit numbers, adding the credit numbers, and getting the difference. The difference between the total debits and the total credits is the balance. The high man wins. If the credit number is bigger, that's what the balance goes on that side, okay? Add the 2 columns and the high man wins, debit or credit. And you can see what we've got going here. Here's our unearned revenue. Boy, everything looks pretty smooth, huh? Pretty smooth. Posting, woo, wow, exclamation point. Selected transactions from the Journal of Vital Inc. during its first month of operations are presented below. Post these to the T accounts. I guess they're asking for us to do that. Cash. Let's do it together, okay? Cash, debit, you would put the 30,000 right over here. Let's see if I can do that. And I can't override this. So you'd have 30,000 there, debit, and then common stock or credit. Accounts receivable, debit, revenue, a credit. And here we collected money from some customers. Cash went up and receivables went down with the credit. Now we come to the end of the month. We feel we've entered all of the transactions that need be entered, okay? We've done some due diligence. Where I worked for many years in other companies, we had a list at month end of the various accruals we needed to make, the prepaid schedules we needed to compute, and we didn't close out until we verified that we had done each one, okay? So that's what this company now has done. They've gone through their due diligence and they say, we're done. It's time to prepare a trial balance. And notice now we're up to number 4 in our journey. Number 4 in our journey to the closing. We started by analyzing business transactions. We learned how to journalize them, post them. And now we're going to run what's called a trial balance. A trial balance. It's simply a listing of all of your accounts in chart of account order number. It starts with assets, liabilities, equity, revenues, expenses, goes in that order. And it's not a formal report. All it is really is a worksheet that proves that the debits equal the credits. That's all. The purpose is to prove debits equal credits. And in so doing, you may uncover some errors you need to check. But where it really comes into play is that once you've got a correct trial balance, you can prepare the financial statements from them. And let's look at your first trial balance. Here it goes. The balance in cash was 15,200, huh? 2,500, 600, 15,200, 2,500, 600. Where did we get those numbers? Got them from the general ledger, the balances. 1,500, 2,500, 600. I see 5,000. And here we go. Debits, credits, etc. So the debits equal the credits. Does that mean that these numbers are correct and we're ready to prepare financial statements? No, far from it, because we know it's going to require some adjusting. And we're going to get into that later, next week. Limitations of a trial balance. The trial balance may be balanced even if everything is wrong. If you forget to do something, or you post something twice, or you do it incorrectly, the trial balance is really nothing more than a check on your debits and credits. But it's an important thing to get right eventually, okay? Here we go. The following accounts come from the ledger of Snowgo Corp. Prepare a trial balance in good form. Our trial balance begins with current assets first, then long-term assets, then liabilities, equity, revenues, expenses. So let's see. I predict that we're going to start with cash, 7,000, accounts receivable. Let's see what else we have here. Accounts, there's equipment, that's an asset, but I see a prepaid. So I'm guessing cash, accounts receivable, prepaid, and equipment will be the first 4 things we see there. I don't see anything else, do I? There we go. Cash, accounts receivable, etc. Etc. Okay. And then we want to do the liabilities. Well, we know accounts payable always comes first. Then we got notes payable. Any other payables? Do I see unearned revenue? No, I just see 2 payables, I think. And then the equity account of $20,000. There's your 2 payables, the equity. The dividends, remember, are debit balance because they reduce equity, and there are your sales and expenses. And that takes us to the end of this presentation, okay? Anybody have any questions, anything they want to talk about? I'm going to stop the sharing. Oh, wow. I lost track of all you guys. Good to see that you hung in there, huh? Most of you. What do you think, Emily? You're okay?
Yeah, sounds good.
All right. Any comments, Hope?
No, not really.
You're okay. I'm going to continue this. John, how did it go today? You feel you
I
picked
thought
up a little
fine.
bit?
I'm assuming no lecture on Monday.
Pardon me?
No lecture on Monday because of the 4th?
I'm not 100% sure. I don't think I can lecture. I mean, I'll be here if necessary. Let me get that information out to you guys immediately. Due to the truncated schedule, we may force you guys to come in and listen to me on Monday, okay?
Okay.
All right. Okay. Kennedy, welcome aboard.
Hi.
Good to hear from you. And finally, is that Gigi or Gigi?
Yeah, Gigi.
Gigi. Gigi, do you make a motion that the meeting is over?
Yeah, I motion to adjourn this meeting.
Okay, Gigi, just kick this all out. We'll probably see you guys on Monday, okay? So look for the notice on that, okay?
Awesome. Thank
Bye-bye.
you.
Bye-bye.
Thank you.